Hi, my name is Dave Jamison with Rainbow Mortgage, and today I'm going to talk a little bit about refinances. Been working in the mortgage business for 20 years, Gail and I have, as your local Minnesota mortgage broker, and one of the most frequent questions I get is, should I refinance? Or Dave, when's a good time to refinance? So I'm going to go over 5 times that it would be a really good time for you to refinance your home. And the first one that we'll talk about is to lower your interest rate. And that's probably one of the biggest ones that I get is, Dave, rates are lower. Should I refinance my house at this time? And a lot of people are like, is there really a good tip as to when's a good time or when's not a good time? Is it 1%? Is it 2%? What's kind of the magic number? Well, to be honest with you, there really is no magic number when it comes to lowering your interest rate. It's really going to be your own particular situation as to when it's going to make sense to do that or not do it. Because there are closing costs involved with doing a refinance. And so you want to be able to recoup those costs in anywhere between 24 to 36 months. So that's tip number 1, is recoup closing costs in 24 to 36 months. If you can do that, that's usually a pretty good time to refinance. Tip number 2 is that a 1% drop in interest rate could be a good time to look at lowering that interest rate. On a $200,000 loan, a 1% drop in interest rate is going to save about $120 per month on the monthly mortgage payment. So if you have $3,000 to $4,000 in closing costs, that's going to put you right in that 24 to 36 month time frame as to when you should actually or if that's going to make sense for you to recoup that money. Now again, there's lots of other reasons that lowering your interest rate would make sense. Maybe you've had that loan for 5 or 6 years and you've got a bunch of equity, so you've got a payment that's much higher. You'll be able to lower your monthly payment even more depending on how much your actual balance is. So that would be one time, is to lower your interest rate. A second time to do a refinance would be to change your program. And what I mean by change program is maybe you have an adjustable rate mortgage right now. And if you have an adjustable rate mortgage that's coming due, maybe it's starting to adjust and your payments are much higher than you started out with, that would be a good time to lock in your interest rate and go with a fixed mortgage. Some of these programs that we did many years ago, the interest rates were low for 10, 15 years, and now they're starting to creep up into the 6% range. So it would be a good time to lock that thing in. Rates are still super low, so let's lock that in. Another big one that I'm seeing is FHA to conventional. So after the mortgage market meltdown, FHA required that the mortgage insurance be for the life of the loan. So even if you pay down your loan 50%, 60%, even 10%, you're still going to pay that mortgage insurance for the life of your loan. So that could be anywhere from $130 to $300, $400 a month, depending on how big of a purchase price you had when you purchased that home. And the only way to get rid of that mortgage insurance is actually to refinance it and get it out of it. So one of the benefits about working with Rainbow Mortgage is that we have the lowest mortgage insurance in the industry. So even if you just did an FHA loan, say a year ago, and you've got mortgage insurance through your FHA loan, we might be able to lower your mortgage payment even if we have a slightly higher rate. And the nice thing is that when you do reach that 80% of the value, that mortgage insurance is going to go away. So touch base with me if you do have mortgage insurance and you'd like to see if there's a way, especially if it's an FHA loan, if you'd like to see how we can make that go away either now or in the future. So change of program is another way that we can help. Number 3 is you can build your equity faster. And how can we do that? Well, we can reduce the term. So by reducing the term, you can certainly save thousands of dollars on the back end of your mortgage. For example, if you've got a 30-year mortgage and you've been paying on it for a couple years, interest rates are super low right now. So we take your rate, or we take your mortgage that you have right now, and we put it on a 25-year, and believe it or not, I can do weird terms. I can do a 23-year term or a 24-year term. So maybe we cut 5 years off, and let's say your principal and interest payment is $1,000 a month, just for example. Now you're cutting $60,000 worth of payments off the back end of your mortgage. That's pretty significant. And what we try and do is we try and find that comfort zone where maybe we're saving you a little bit of money, but we're reducing that term so that you do get that savings. So you're saving a little bit monthly, but then you're saving a bunch on the back end. And then that's how you build the equity quicker, because as most people know, mortgages are front end loaded with interest. So you're going to pay a lot more interest in the beginning, and then it accelerates and you're going to pay more principal as you get further down the road. So if we take 5 years off or 6 years off or 3 years off of your mortgage, you're going to start building equity a heck of a lot quicker than you are with the typical 30-year fixed mortgage. So it may be it's kind of a fixed savings plan for you for down the road by paying that extra money into your mortgage. The fourth thing that we're going to talk about is if you've had your credit score improved. So number 4 is a credit score improvement. So a lot of times the way that mortgages work is it's tiered pricing. So the better your credit score, the better the rates that you get. The lower your credit score, the less favorable rates you get. So maybe you purchased your home and you've just gone through a bad situation, lost a job, a divorce, something like that, and your credit score is not what it was before those bad things happened. So it was down in the 640s. So maybe you did pay an actual premium for that rate to purchase your home or refinance it the last time. And now, a year, 2 years later, you've worked really hard, your credit score is improved. Well, it might be a good time to take a look at it and see if we can get you a better rate. Because again, even if we can drop it 1%, like I mentioned earlier, on a $200,000 loan, that's $120 a month that you'd be saving. So if your scores improve since you did your last loan, give us a call. We'll do it. We'll take a look at it. We'll do an analysis for you and see if it makes sense. If it doesn't, we'll tell you. If it does, we'll also tell you that. So give us a call on the credit score. And then the last reason to refi, number 5, is to use the equity in your home. Now, equity in your home, a lot of people like to have as much equity as they possibly can, and that's a good thing. But sometimes it makes more sense to actually use that equity. And what could you use that equity for? Oh, there's so many things. One, you could use it for remodeling. You could do a remodel on your house and take that equity and do a cash out refinance and take out the equity in your home. Number 2, you could use it to pay off bills. Sometimes at this time of year, and this video is being recorded right after Christmas 2019, so we know what's going to happen in January of 2020. If you put that Christmas present or those Christmas presents on the credit cards, those bad boys are going to start to roll in next month. And sometimes it can be pretty daunting what that bill looks like, and it can just kind of snowball. So a good thing to do is to do a cash out refi and pay off all those high interest credit cards, save your money on a monthly basis so that you can do good things with that money, like paying it towards your retirement, or maybe you have a child that you want to pay for their college, you can start putting money away for college. Any of those types of things will really help if we can save you some money. I did one last year where we literally saved a client. He was a retired client, and we did a cash out refi. We actually increased his rate a little bit to do this cash out refi, but we saved him over $900 a month. So somebody on fixed income saving $900 a month, that's huge. And even if you don't have fixed income, saving that $900 a month could be super huge. Another use of equity could be to, I think I already mentioned this, you could use it to fund your retirement. So some of us have been working a long time and we've been paying for hockey, softball, whatever it might be, and so maybe we're a little short on this retirement fund. A good way to put a big chunk into your retirement fund is to take some equity out of your house. Equity, when people talk to me about equity, they're always worried about taking the cash out because they're like, oh, I'm taking the equity out of my house. But you know what? Equity is just a function of math. It's how much do I owe, or it's how much is it worth versus minus how much do I owe. And so it doesn't, what's interesting about equity is it doesn't compound on itself. Basically, it just goes up incrementally every year based on appreciation. Whereas, let's just say we'll take that client that I was talking about where he's gonna save $900 a month. He's saving $900 a month. And simple math, that's over $10,000 a year that he could be putting away towards savings. Now, if that's you, maybe if you have $900 in credit card debt, car loans, student loans, whatever that's sitting out there, and we can save you $900 a month, and you can, even if you started putting half of that away, think of how much further you would be. Now, I can't really give you rates of return because I'm not a financial planner. You'd have to talk to a financial planner about that. But if I could free up $400, $500, $600 a month for you by doing a simple refinance and paying off those high interest credit cards, think of how much further you'll be 5-10 years from now. And guess what? We're not adding any debt. When we do payoff of debt and funding retirement, we're not really adding any debt on these things. We're just taking the same kind of money and we're just moving it around and putting it in a more advantageous place for you. So I hope these 5 keys have kind of made sense to everybody. And if any of these fit into your particular situation, give us a call because we do no cost initial consultations. We'll look at your situation. We'll actually sit down with you. We love to sit down with our clients. We treat everybody like family. And so if you were my father, my mother, my brother, my sister, I would sit down with you. I would go over this information, make sure you understood it, and make sure that it was the best for your particular scenario. So if any of these 5 are you, give us a call, shoot me an email. There'll be contact information at the end of this video. And let us know what's right for you, and we'll get to work right away for you. So as we start 2020, which is when this video will go out, these are 5 reasons to refinance, and give me a call if any of them are you. Have a great day, and again, I'm Dave Jamison with Rainbow Mortgage Inc., your local Minnesota mortgage broker helping Minnesotans for the last 20 years.